Hey everybody, welcome back to this channel. I have a bit of a controversial video for you, and that's regarding whether I believe technical analysis is useful. Now, I have a bit of a nuanced opinion about this because on the one hand, it has real use and you can learn a lot from it. You can learn a lot about the psychology of other people. On the other hand, it's for practical use. In my opinion, I don't find it useful, but let's get into it. You feel free to disagree or agree. This is just from my personal discovery. My own personal experience has showed me this. So the reason why most of the time I don't recommend people get too much into technical analysis is because from what I can tell, most people are using technical analysis to speculate on the market. And to me, this is a no-no. If you watch my previous video about why I believe people shouldn't leverage trade, it's ultimately for the same reason. For people that are trying to speculate in the market, what they're really trying to do is they're trying to win at another person's loss. And that's how it is. When you're playing the speculation game, whether you're trading with leverage or even on spot, you're hoping that you're able to make some kind of gain, but that gain has to come at a loss. It's what we call a zero-sum game. For every time that you make a win, whether that's a 2x or 1.5x or a 10x or whatever, an according amount of people has to lose. Usually, and it's just a rough estimate. If someone 10x's their money, roughly 10 other people have to lose their money, right? So the dynamic plays out in this way. Think about it like this. When everyone's speculating on the market, the person that wins is the person who has the most accurate understanding about what the real price is. Now, what is the real price? The real price of any given commodity is subjective, but one person is going to be more correct than the other. And the person that's most correct about its real value is the one that's going to win against all the other speculators. Now, there's a study done, and it's got to do with a bunch of people being quizzed on what they estimate how many jelly beans are in this jar. There's a jar full of jelly beans, and every person, it was like a couple of hundred people, has to guess how many jelly beans are in this jar. And the person that has the most accurate guess of how many jelly beans are in this jar is the one that takes home the prize of the jar. Now, there are some people that will way off. They either guess too little, and there are many people that guess too much. But what the researchers found that was very interesting is that the sum total of everyone's guess, hundreds of people guessing just on face value how many beans were in this jar, the sum average of all their guesses actually ended up being very close to what the real answer was. So you can think about this when you're thinking about what the real price of Bitcoin is, or any commodity. Everyone is collectively guessing about what it is. Everyone's got different information that's given to them. Some people might have a real insider information. Some people might be really good at technical analysis. Other people might be very good at fundamental analysis. Other people might be drawing experience from trading other securities or something like that. And then there's the influence of the media and word of mouth and all these things. So the conglomeration of the mass psychology of all people is going to point in a particular direction, and that's going to give us the market price. And that's what you see what the price is right now. Everyone coming to a collective conclusion about what Bitcoin is actually worth. And if you're in the speculation game, your idea, your goal is to be more correct than everybody else. Now, you're thinking in a future time frame, 10 or 20 days from now, how is the market going to change, and where is the price actually going to be? And if everyone has the same idea as you, then there's not going to be any volatility. Therefore, you can't really win off your speculation. But when there's a vast difference in how people think about what the price really is, that's when you get volatility. When a lot of people think the price is going down or going up, that's when you're going to see big swings. And that's when the person who has the most correct guess about what the true value is the one that's most likely to place the correct bet, and they're the ones that are most likely to win. So now we get into technical analysis, right? So technical analysis is a way of measuring other people's psychology in regards to how they see the price. So I want to just quickly show you here what some of the technical indicators that I use. I just as to preface, spoiler alert, I don't really take serious stock of technical analysis because I don't want to be involved in the game of speculation. That being said, I've studied it very seriously and I've used it throughout the years. But over time, I've used it less and less for speculative reasons. The reasons why I actually know a lot about technical analysis is because I used to do a lot of degen shit, and it worked a lot, and it also didn't work, right? But the good thing is I do know a lot about technical analysis, and I want to show you some things, and these indicators that I use, and you can feel free to use them as well. I've just got TradingView open right now, and all of these indicators that you see here are free indicators, right? And I'm going to go through and explain a few of the technical indicators that I use and explain from the perspective of human psychology about why these things might work and why they might indicate where the price is going. But I'm also going to explain why I still wouldn't use them. So let's look at this one here. So this one is the wave trend indicator, and this has been readapted many times, but this is the original one. Let me get rid of all this other stuff now, just so you can see clearly. And you'll find that many many indicators employ a very similar metric where they've got two lines, right? These are two lines that are averaging various things, right? And when these two lines cross, it goes into so when it's going up and then it crosses, you know, if you know the green line closes below the red line, it prints a red dot. And usually that means the price goes down, right? And if it's above here, like so, as we can see here, right? We can see. Let's use this example. I hope this is clear, right? So I'm using the weekly time frame. If I zoom in, when you see like there's a red dot and it's all the way up here in this overbought territory, right? And this green has crossed below this red line. This green line is crossed below this red line. It usually indicates that we're oversold and we're gonna go down, right? And then when this green line goes above this red line, it prints a green dot, and then we start going up, right? It's a very crude understanding. I'm not going to go into the specifics of exactly what it's measuring. There's thousands of indicators out there, and usually it's just measuring inflows and outflows and stuff like that. And there's usually some algorithm that's measuring it, right? And if you look purely on this previous data here, it looks like it's a solid thing, right? Every time you see that there's this green dot here, look, the price moves up. And this is on the weekly time frame. We're not talking on a second time frame. So theoretically, you could speculate, right? Look, green dot, whoa, we go up. And then red dot, whoa, we go down. So what if you just bought on the green dot and sold on the red dot, right? You're genius, right? What would be the problem with that? Well, it's really easier said than done. Like when you're looking at previous data, it seems so obvious. But there's always some exception to the rule that only manifests itself in real time. And it's very easy to get caught in these biases, right? Because there's also times when there is a red dot, but then the price doesn't really go down that much, right? Like see, like right here, right? Like here's a red dot, right? And it's it looks like it might just go down, and as you can see here, the price came from a bottom of 15.5k, right? And then we go all the way up. We go up so much, and then there's a red dot here. And, we've gone up by 25%, it's now almost 22k. Many people may have just sold in March 2023, completely missing out on this enormous bull run that happened, right? And when you get too much into technical analysis, it becomes very easy to buy into these indicators and what they seem to promise. And you'll kind of avoid looking at the times where it didn't work and focus on the times that it did work, right? And then if you do speculate correctly and you use this chart and you're able to make a big win, it's very easy to justify that it's because you bought at the green dot and that's all you did. Like if I just bought at this green dot here, I could say, well, it's because of this green dot I bought at 15k, right? And it's very easy to get into these kinds of delusions. And I think a problem with technical analysis is that it can be there are a lot of mental biases, that pitfalls, I guess you could say, that are very easy to get into. But that being said, like, it's still generally useful, but I wouldn't be using it for the purposes of speculation. I want to pull this one up real quick. Hash ribbons. This is actually my favorite one. It's probably the only one that I really take seriously. But then again, as I mentioned, I'm not trying to speculate. But this is, I won't go into too much detail here. But this has got something to do with the hash ribbons. So there's a I'm not going to go into it. I'm just going to speak on totally face value, right? There's these buy signals, right? let's just make it like as dumb as possible, right? There's these events called mining capitulations, and you'll see here there's a capitulation and it goes into this red zone. Often the price will go down, and then you'll see like a buy signal and it'll go up. And to be fair, if we just look through the history, every time there is this buy signal, the price goes up quite substantially, right? So that's the last time it happened in August 2023, and then before that was January 23. You've got a buy signal that it goes up, and we've got here August 21. As you can see here, there was a big run up, and then here again, December 20, buy signal goes all the way up. June 20, again, it just goes up. April 20th on the 2020, it goes up, right? So it seems like this is a perfect indicator, right? And it's done very well for me, and I suggest many of you use it. It's called the hash ribbon indicator on TradingView, right? But then let's go one further, right? So here's one here, and this is December 23rd of December 2019, and it goes up. It says buy, and it goes up, and then I think this is the COVID dump, right? And the COVID dump, I know, was just kind of just a completely random event no one really expected, right? But again, this is one of those things that it's the reason why you can't take the technical analysis stuff too seriously. The people that use this stuff for the purposes of speculation, it's very easy to get burned, because you might say, well, look, if I longed every single time I got a buy signal, then I'd make money, right? But it's never really that simple. It really is never really that simple, especially if you're going to play with leverage. If you're playing with leverage, there's a lot of other factors involved, like for those who aren't familiar, I don't want to get too into it, but there's just, for those who are familiar, there's what are they called again? Open interest rates. So it's like every 8 hours you have to pay a certain percentage of your position to the platform. So the longer you're in that position, the more costly it becomes, and therefore you don't really have a lot of time to wait for the price to go up. So you might, in general, have the correct idea that when the buy signal pops up, maybe it does come up, but you don't know if it's going to go up today, or you don't know if it's going to go up 3 months from now. You just know it's going to go up. But if you opened a long position, say on Bybit, that open interest could end up killing your position in the end, and you could lose, like, I don't know, 50% of your overall position just in interest fees by the time the price eventually goes up. And you could say, well, maybe it's worth it. I don't know, it could be worth it. I'm not saying that you definitely shouldn't do it, because I do think there's value in technical analysis. But what I will say is most people are likely to get burned if they do it for the purpose of speculation, and especially if they're doing it with leverage. So where can technical analysis be generally useful, right? And I say generally useful because at the end of the day, when you're using technical analysis, the risk is that if you're going to do it with the purpose of speculating, there's always a chance you're going to get burned. So where is it possibly useful? Well, at some stage, if you're buying Bitcoin, maybe you're looking for an entry position, right? Now, this is one use case, but the reason why I still wouldn't even recommend that is because I think most people would just be better off if they DCA, right? I think just DCAing every week, every month, whatever, is the most standard correct thing to do when you're getting into the market. That to me is better than trying to pick the best time. But maybe you're in a situation where maybe DCAing is not necessarily possible. Or maybe here's another example, right? Maybe you decide that maybe you've pulled out of the market, you've got a bunch of money sitting in Tether, and you're waiting for the correct time to go in, and you know it's generally the correct time, and you don't necessarily want to be DCAing your funds back in every week. You just want a general time frame to go in. So what you could do is, like, an idea is, like, you can DCA and say, okay, I'm going to put all my funds in, but I'm going to do so over the next 3 months, right? Rather than, over the next 2 years. Do it over the next 3 months. And then maybe you could use technical analysis to decide when the best time to DCA in a limited time frame. So maybe you see, like, a mining capitulation has happened. Just an example, right? Just an example. You see a mining capitulation has happened, and it's, I don't know. Well, forget the time frame. Forget when it is. It's just a hypothetical, right? You see a mining capitulation, and you decide that the price is probably going to go up, right? And you decide, you know what? I'm just going to put, all my money into crypto over a period of 9 weeks, and you just put, a little bit amount of money every day over 9 weeks, ever since you see the mining capitulation, the buy signal comes up. You don't get too excited. You're just still slowly putting money in. And then that is an example of how I would use technical analysis to enter into the market. And then you can do the reverse thing, right? Another good technical indicator that you can add to this list is I think a pi cycle top indicator. This has actually served me well before. I've actually used this. I remember it helped me get out in the middle of 2021. So maybe you decide, the price is up, you see the pi cycle top indicator, and you decide, you're not going to just pull all your money out straight away. You decide over the next 9 weeks, maybe next 6 weeks, you're going to pull all your funds out just every day at a time. When you see that pi cycle top indicator, you're just going to slowly start pulling out. So I would, if I had to use technical indicators to make a decision about whether I'm going to pull out or go in, I would combine it with another strategy of DCAing to make it work. Now, in that sense, I think it can be good, right? But there's still so much that there's only so much that it can do, and it's not going to be useful for the average person, and it's not even because it can't work and it doesn't have great utility. It's just because it's something that's useful for speculators, and even then, I think most speculators get wrecked in the end. And for the average person watching this video, speculation is not your game. Leverage is also not your game. Stay away from leverage, stay away from speculating, and I think you're going to have a generally good time. Just play the long game, right? Just trade spot, DCA. It's the same rules that everyone's been talking about for a long time. Don't try and beat the market. Bitcoin is already the most overperforming asset of all time. So don't get ahead of yourself. Take your time. Don't try and outpace the mass market psychology, because it's a lot to beat. And yeah, so if you like these videos, I suggest subscribing. Check out some of my other videos. This channel is about debanking and reducing your need to rely on traditional financial institutions using cryptocurrency. And the main vehicle for this is peer-to-peer trading. And peer-to-peer trading is a way that ordinary people can buy cryptocurrency without A, KYC, and B, using multiple different kinds of payment methods, not just bank transfers, but PayPal, TransferWise, Revolut, etc., using these kinds of unorthodox payment methods to buy Bitcoin. And if you're interested in getting into peer-to-peer trading, you can use my referral link in the description below to sign up with the following: Local CoinSwap and HODL. These are two non-KYC exchanges, but if you don't mind a little bit of KYC because you can get better rates, you can sign up with my referral link to Bybit, Binance, and OKX. So yeah, thanks a lot for watching this video, guys, and I'll see you in the next one.